Everyone and welcome to this week's FX update. My name's Craig Erlam, Senior Market Analyst at OANDA. Thank you as ever for joining us. It's been a few weeks since we've done one of those. Of course, last week we had the NFP special with my colleague in New York, Ed Moyer, which I believe went extremely well. Again, another relatively lively event. I think it's safe to say a lively week. I think that goes without saying. Thank you as ever for joining us. Today we're going to take a look at some of the key events which we are foreseeing in the markets this week. I'm sure for many of you there won't be too many surprises with respect to this. It is very much the usual lineup with regards to many of these things. Hopefully on your screen right now you should be able to see the MarketPulse website. This is where myself and my colleagues post of all our content throughout the week. And it's also where you'll find a copy of this recording later on, assuming you are not currently watching the recorded video, which will also be found on YouTube, Twitter, and everywhere else. On here is also where you'll find the economic calendar. We're not going to spend too much time on the economic calendar this week, though. The simple reason being that we'll get to some of the major topics this week: trade wars, Brexit, etc., as we are going through the currency pairs. And I want to spend a little bit more time on the charts themselves as well as covering the fundamentals. And the other reason really for this is that I just don't feel like there's an enormous amount to talk about this week from the economic calendar standpoint. The only real key events which you can see here are the Fed minutes and the ECB minutes. And even here, I don't feel like they are going to be knockout events as they may occasionally be. In both cases, we saw monetary stimulus last month. In both cases, we had new economic projections. And in both cases, we did see the views of particularly the Fed chair and the ECB president. But it was very much came across what the views of the both respective central banks are and what it means for monetary policy going forward. I also think from the Fed's standpoint as well that a certain amount of time has already passed now since the event. So really the Powell speeches today and tomorrow will probably offer us more insight, assuming he does venture into monetary policy, a current monetary policy. They'll probably offer us better views on where things stands, that and other speeches from various policymakers over the course of the next couple of weeks. You will see that we are back in interest rate cutting territory with regards to the Federal Reserve. The central bank has already cut interest rates twice in the last two meetings, one at each meeting by 25 basis points, but markets just haven't had their fill just yet. At this moment in time, markets are pricing in an 80% chance of a cut at the next meeting, so that's extremely high. And then at the December meeting, a 40% chance of a second, so another 2 interest rate cuts, taking it to 4 interest rate cuts in the final 4 meetings of the year. That's some extraordinary stimulus when you consider that the labour market is still extremely strong, that the growth in the country is still around 2.5% on average, and we are not in extraordinary economic times. But of course, the trade war and other factors are affecting the US economy. We've seen that in the manufacturing and services PMIs over the last week, particularly that from ISM, which the markets reacted very strongly to, suggests that the US isn't immune. The old saying goes, when the US sneezes, the world catches a cold. And it seems that now the US has caught the flu. So, I mean, there are weakening signs. That being said, whether that warrants a full 4% interest rate cut, given the limited scope that the Fed has for rate cuts, that is obviously debatable. But at this point, it's also irrelevant. Markets are heavily pricing in at this stage, and if the Fed feels backed into a corner again, then you can assume that they will act. If we do move on to the charts, I do feel like we are seeing some really interesting movements at this moment in time across a number of different currency pairs. We'll go in the same order as usual, and if you've got any questions, as always, the benefit of these webinars is that you can ask the questions and I'll do my very best to answer them. And like I say, we'll just try and get through and maybe even finish on time for once. So in euro dollar, there was a lot of emphasis around euro dollar when we broke the 109s last week. We'd broken through that support, which had held around 109.25, 109.30. and it looked as though the pair was stabilizing a little bit. But the real giveaway here was the fact that we were continuing to see lower highs. So from a purely technical standpoint, there was no sign of the trend actually reversing. There was a sign of potential trend weakness, and you could see that again from the momentum indicators at the bottom, but not necessarily signs of the trend itself actually reversing. But then we obviously saw some more strength in the US dollar. We saw a lot more risk aversion, and that lent itself to a stronger dollar, of course. There's many risk safe haven assets around, whether you're looking at traditional safe haven assets like gold, traditional safe haven currencies like the yen and the Swiss franc, or whether you're looking at safe haven bonds like the Bund. But US Treasuries is a very strong prospect as far as safe haven goes, because not only is the US dollar the world's reserve currency, but US Treasury is actually yielding more than many other bonds around the world, particularly when you're looking at German debt, for example. So it's a very attractive safe haven. So it's not a surprise that when we're not talking directly about US, something that's purely being inflicted on the US, which may have knock-on effects elsewhere, but when you do see just general risk aversion across the markets, it's no surprise to see US dollar performing quite well. And that's really what dragged the euro below the 109s. And all of a sudden we're in that 109, 108.50 territory. Now we have to go back quite a while to find out when it is that we were trading back here, but you can see here around the early 2017 time, but even late 2016 as well. That 108.50, 109s, the currency pair got stuck there on a number of occasions, finding support here in 2016, but then going into 2017, turning into resistance, and then back supporters again when we eventually did break higher. So it was no surprise that we saw it run into some support here and run into support as well on lagging momentum. So even though we did break lower, we didn't see an uptick in momentum, and that's what we always say with these things is if you go and see a breakout, you want to see momentum following it. You want to see that confirmation that there is some substance to these movements, and there was no momentum again. So this always looked like a bit of a weak breakout. That doesn't mean that we're going to see a trend change though, as I mentioned earlier. The fact is, this has been in a long downward trend. It's been a very gradual trend throughout, and the US dollar is continuing to outperform other currencies. And until we see a significant change in this, then it's really difficult to back a strong reversal here. Now, there are indicators that we could look for that may indicate otherwise. For example, if we see a break of 111, that could potentially signal a trend shift, not necessarily a trend change, but a trend shift. And what I mean by that is that could potentially suggest that we are heading back towards the kind of 112s. And that could potentially suggest that we're going to see this resistance tested. A breakthrough 112, that would suggest to me we could be in trend change territory. Then we've gone through the declining channel that we've seen building now for quite some time, going back to late 2017. That would take us through the 200 and 233 day simple moving average that the pair has tracked below throughout the majority of that time. It would also take us through previous areas of support and resistance, major areas of support and resistance at that, and that would potentially then signal a trend shift, a trend change. But at this moment in time, short-term shifts are likely to happen. So if we see a breakthrough 110, which we're struggling here over the last 4 days, then 111 starts to become very interesting. It is notable that if we look at this daily chart, yes, 110 has continued to hold over the last few days, but you can just see rising lows below that. So I wonder whether there is upward momentum building in the near term into that 110 that could potentially cause a short-term breakout to the upside here. Again, not a longer-term indication at this stage, but certainly an interesting short-term shift. And that takes us really to the trade war before we move on to any Brexit chat, because we are going to see more trade talks this week later on in Washington between the US and China. I don't feel like there's been a dramatic shift here. There's always going to be headlines, there's always going to be news flow, and as far as Trump's concerned, there's always going to be Twitter. What you have to do, though, is pick and choose exactly what you find to be significant in all of this. And I haven't seen anything overly significant so far. If anything, the most significant thing I've seen is a Chinese willingness to accept a more limited trade deal. Take out the components where there are disagreements, put them to one side, talk about them next year, but get a trade deal agreed among everything else that can be agreed and has been agreed in order to try and protect both economies and of course, as a result, the global economy. Now, eventually, that is an idea that may float with President Trump in under a few conditions, at least one condition. One condition being, if he starts to think that his poll numbers are suffering heading into an election, then a limited trade deal at the opportune moment could become more appealing. The second condition prior to that is always the Dow. How are the stock markets performing? If the stock markets are performing badly, then I think Trump may start to think differently, especially if that starts to affect his polls, the knock-on effect. And then, of course, there is the economic data. We are seeing weakness already in the economic data. He's very quick to point the finger towards the Fed in terms of who's to blame for the weakness in the data that we are seeing. But if things like the labour market figures start to get hit, then you may start to see a gradual shift from the president. Because again, the last thing he wants to see is rising unemployment heading into next year's election. So these are all intertwined factors. But if you tick every box here, then I think a limited trade deal is almost guaranteed, unless, of course, the Chinese change their mind and decide we're going to let you go into that election not knowing if you're actually going to win. But again, then it's all about the gamble. And it's quite clear that the Chinese economy has been suffering. We'll see where we end up later this week. But like I say, a lot of the noise is just usual noise heading into these trade talks. This is when Trump gets fiery. This is when Trump tries to turn up the heat. That's what people are linking the blacklisting of 28 Chinese companies at the start of this week to, turning up the heat, becoming more ferocious, heading into these trade talks, ramping up the pressure. Nothing new there from Trump, and I expect more of that as the next couple of days progress. Moving on to cable, obviously the pound has now come under some pressure today. It's been coming under pressure really for the last 3 or 4 weeks, and ever since it reached those highs of 120, around 126. Now that actually came following the initial breakout from that descending channel. We entered into the 38.250 fib range, and it looked as though we were just taking pause for breath. There could potentially be more to come. To what the 127 areas, 126.70, 127 did look to be the more significant area, the one to watch potentially if we could get that far. But sentiment has turned a lot more sour since then. The speculation around no deal Brexit has been ramped up. We are now less than a month until the UK potentially leaves the EU. We're a week away from the EU Council meeting, when the final negotiations, I'll say that in quotation marks, because how many last minute deals have we seen from the EU over the years? That's not to say that this is possible on this occasion, but again, I'll always take these dates with a relative pinch of salt, and I think that's really what Boris Johnson and his team are kind of banking on, is a last minute deal, if I'm quite honest, and he's not even being particularly discreet about that. But the reason why the pound's come under pressure again today is because of an apparent phone call between Boris Johnson and Angela Merkel. This has been released or leaked, I should say, via number 10 sources, again in quotation marks, suggesting that Boris Johnson had a conversation with Angela Merkel, and the two just couldn't agree on a way around this. Boris Johnson insisting, of course, on his proposal, which keeps Northern Ireland tied on as far as the single market's concerned, but on customs keeps the Northern Ireland tied to the UK, and came up with a variety of ideas as a way of getting around that, including customs checks away from the actual border, so that we don't need infrastructure on the border between the Republic of Ireland and Northern Ireland. Now, this has been not necessarily rejected by the EU. The EU have said that the ideas are interesting, but there are a number of flaws, which means it's not implementable in its current form. It may be the basis for the start of a negotiation, but not the basis for an actual deal. And the chances of that becoming part of a deal by the end of this month are very slim. Whereas this morning, the leaks suggested that Angela Merkel effectively told Boris Johnson that the Northern Ireland will have to remain in a customs union with the EU permanently in order for a deal to be agreed, and that this is the red line by Boris Johnson and the DUP, of course, the partner party over in Northern Ireland. And Boris Johnson has effectively suggested that it's impossible to get a deal with these kinds of demands. Again, let's take two things here. One is we need to find out if these reports are confirmed, if these leaks are real, or if this is another PR offensive from the Boris Johnson team, something he's not necessarily scared to engage with. So we need to find out how much facts there are contained within this. We need to know if the EU shares this view of Angela Merkel and whether there is a way around this. And then obviously we need to know if there's a plan B in place, because if this means that we're heading for a no deal, we're still a far way away from that, even though we're only 3 weeks until the end of the month, because of the bill that was passed in Parliament, forcing Boris Johnson to request an extension in the event of no deal being agreed by the middle of this month. But it is an interesting development, and it has put pressure on the pound again earlier in today's session. Interestingly, though, not an enormous amount of pressure. We've seen far worse days on many, many occasions over the last few years, which means that traders are potentially looking at this as a negative development story, but not necessarily that big a game changer. This could be a lot of posturing on Boris Johnson's side. We'll see how that does develop, but that's put it under pressure a little bit this morning. I'm sure there's going to be a lot more, I should say, and that's why the pound is likely to remain extremely volatile over the next few months. I'm sure there's plenty more of this to come. But we're back in this area around 122. And what makes this area very interesting is following the breakout through that descending channel, we rose towards the kind of close to 126 levels, and we've retraced back into the 50 to 61.8 fib zone. If we break through 121.97, call it 22, then we're through the 61.8 fib. In that scenario, I may add a 78.6 fib, just because this is the first retracement following a long decline in this currency pair. But it would suggest weakness in that breakout. And when we're talking so close to Brexit Day, I do think that could potentially be a factor. Even if I add this now, add the 78.6, then that adds 121 as a major level of potential support here. So one to keep an eye on, but this is showing some weakness. Naturally, it would have been great to see us head towards the 127s first. At this point, unless we're confident of an extension, that may be unachievable, especially if we are in fact heading towards a no deal. But again, I would always stress with this, just be careful. This is going to be an extremely volatile currency as the days and weeks now do pass by. Which takes us to euro sterling, the euro against the British pound. And again, we are seeing some weakness in the pound today. What's interesting here is we did see a breakthrough 91 on the back of that pound weakness earlier on in the summer. We have corrected back in line with the pound's bounce back towards these kind of 88. So we've gone through that 90-91 zone again. But we've come up to 61.8 fib here around 88, and that's where we've started to rebound higher on the back of some of this sterling weakness. So this is a more technically significant rebound than what we saw in pound versus the US dollar. This doesn't necessarily make me really bullish in the longer term. To be quite honest, one of the reasons is I don't think the euro's just got the strength to really drive this back through 93 and above. And I think only if it looks as though we're heading towards a no-deal Brexit do I think that we could be breaking 93 here. But it could be the start potentially of a significant setup. So that's one reason why I am keeping a close eye on it. If we break through 90, then 91 becomes an interesting level. If we break through 91, then 93. 92 along the way, and this sounds obvious because they're big round numbers, but as you can see here, this market is respecting big round numbers, so there's no reason why I'm not going to. We've obviously gone 88, 90, 91, 93, so there's no reason to not respect the ones in between along the way if need be. But again, this just feels like one to watch in the mix. We need to start to see how much fact there is behind these reports this morning, which is really what's dragged this pair higher. Prior to this morning's rally, this could easily have been called a consolidation, a rising wedge following a strong sell-off in the currency pair, which would have looked 88 look a little vulnerable. It's only this morning's rally on the back of these headline news, of which there's going to be plenty, that has dramatically changed that. Of course, the other thing you could do here is add a fib in the other direction from the recent highs to the recent lows. And in that situation, I would probably change the colour as well, just to see what kind of region we're playing with here. So if we make this one purple, you can see that the 50 fib starts to come here around 90, 50, 61.8 fib around 91. So again, coming into the low 90s, the high 90s, sorry, that's where this starts to become interesting as a possible rotation point. So potentially something to keep a close eye on here. But again, very volatile, very news driven. Aussie dollar, US dollar still looks relatively weak, although not an enormous amount has changed. We've still got the resistance here around 68.50. Call it 68.50, 69, down through 68. This entire area has been long-term support at this point. Long-term support turned resistance at this point. And then we've still got 66.50, 67 below, which continue to provide support. If we can see a break through those 67s and put some pressure on that descending trend line, then potentially this 70 becomes really interesting. But I'm getting really ahead of myself, and it's something I've wanted for a long time, as a breakthrough 70 and a breakthrough the 200 and 233-day simple moving average, which has nicely contained this pair all the way down. The worry I have is that we're still seeing lower highs, and we've got this flat bottom at this moment in time. So I'm not particularly optimistic. If we can end the series of lower highs and we can break through, say, 69, and you've got this kind of double bottom potential set up by then this could start to look a lot more interesting. But again, not counting my chickens at this moment in time, because we've got an Australian central bank that is cutting rates and open to more, and a Fed which is reluctant but doing so, being effectively dragged along. We've seen a nice little rotation here in dollar CAD, which is interesting. Now this screen looks a little messy, so apologies. But I mean, I could even remove the moving averages because they don't feel particularly relevant at this point on this screen. And what we've actually seen is we saw a break through that rising channel, which we were watching for a long time. We came back towards around 130 and we've rotated higher. This looked like a typical correction. Now, at this point here, it looked as though this could turn into something more than a correction, because the lows were building and the highs were remaining relatively flat. But instead, we broke lower. We lost momentum in the rally on that last move higher, and following then we just smashed lower. But we haven't gone back to the lows, we've gone straight back to the highs. So what this leaves us now is with a setup where we've got kind of a flat resistance around 133.50, but we have now got rising lows. So this now starts to look a lot more bullish, and that 133.50 starts to look a lot more vulnerable. If we do see a break of 133.50, then this area around 134, 134.50 looks interesting, but really I think it could be more significant even than that, and suggest that we have seen a resumption of that uptrend. If we see a break through these previous lows and through the kind of 132s, through the rising trend line, then that suggests that, again, we're seeing a resumption of the more recent downtrend. But even in that situation, only 130 break through these kind of 130, 130s truly confirms that. So again, an uncertain period for the dollar CAD pair. Sterling CAD, there's not too much to add here again, apart from the fact that the pound is continuing to be volatile. I find this one really difficult to read. We came back, we tested the 61.8 fib following a breakout from this long-term downtrend, but the downside pressure on this Brexit headlines are persistent. So at this moment in time, that 162 looks more vulnerable than the kind of 167s to the upside. But again, that can change in a headline, to be quite honest, and there's not really much more that I can add from a technical standpoint. Kiwi dollar is very much like the Aussie dollar, continues to look vulnerable to the downside. We've got key levels here, 162.50, 163.50, 164.25. But we are just contained in this range for now. Potentially got a bottoming pattern forming, given the fact that we've seen a weakening trend during the most recent declines. But again, I think we need more information here. And again, one central bank which is cutting interest rates aggressively, and one which is being dragged along reluctantly. Dollar yen looks a lot more interesting, to be honest, because we finally did break out of those lows. We broke through 107. We tested 108. That held pretty much, give or take. And now we're seeing the previous resistance level around 106.50, 107 being tested from above. You've got to remember, we also broke through the Ichimoku cloud when we tested those 108, and we're still above the Ichimoku cloud now, testing it from below. A break of the Ichimoku cloud by the lagging line effectively confirms the initial breakout. We have not seen that yet, so that hasn't been confirmed at this moment in time. But if we do, then attention just goes back to these 108.50s, 109s. Again, longer term support, turn resistance here. And this is where it would probably coincide as well with the 200 and 233-day simple moving average. I feel a little bit bullish here, but again, risk sentiment is shifting from day to day in the market, so it can be difficult to say. But at this moment, I feel like there are some bullish flags popping up, which could make this pair a lot more interesting going forward. Not least, of course, Japanese central banks' willingness and the expectation around an interest rate cut and some more stimulus, which will be very interesting given what they're already engaged in. Sterling yen also broke above here, but there's no point me repeating myself on the sterling side. If we break below 130, then this starts to look a little bit messy to the downside potentially. We've not broken above the cloud from a lagging line perspective, and the recent trend has been soft, including today. Risk aversion combined with weak sterling obviously naturally lends its hand to bearishness in this pair. 130 is a big round psychological number, so that could again be quite interesting from above. But again, the Ichimoku cloud being taken out prior to the confirmation coming from the lagging line, and this starts to look a little bit messy. Of course, any rotation higher on a sign that we're going towards a Brexit deal, which at this moment in time looks unlikely, or that Boris Johnson won't be able to defy Parliament, meaning a Brexit extension, could be enough to swing that in the pound's favour. But I feel like there's a lot to go prior to that. Finally, Euro Yen. Again, we do seem to be bottoming out here. We fell as low as 116, we've rotated higher. Since then, we've really found strong support around 117. So you almost have this kind of inverse head and shoulders setup forming now. If that 117 can hold them, we can really test that 120 from below. Then this could start to look a lot more bullish. A breakthrough 1020 doesn't just take us through the neckline of this inverse head and shoulders. It takes us through the 55.89 moving average, through the Ichimoku cloud, and potentially could even drag the lagging line through the Ichimoku cloud at the same time. So you almost get a triple whammy here. So that could be a really interesting one to follow. A breakthrough 117 isn't the end of the world though. Then eyes on 116. Again, a failure to break below here. A new higher low being made. Lost momentum. Could all be bullish warning signals. But it would be great if we could see a breakthrough 120, and that could potentially be a lovely little bullish signal as far as this market's concerned. Okay, that's all we've got time for this week. Thank you very much, everyone, for joining us. As ever, do check out the OANDA MarketPulse website for all your content, including the recording of this webinar. Subscribe to our YouTube channel. Subscribe to our podcast, OANDA Market Insights. And if you're watching this video on YouTube, don't forget to like and subscribe and leave any feedback in the comments box below.